Opendoor has had one of its most eventful weeks in months, and it's leaving investors with one big question. Which side will win out, the growing retail optimism or the continued skepticism from Wall Street? This week really encapsulated the push-and-pull dynamic that's been shaping the stock. On the retail side, we've seen excitement building, first from a company's Q2 results showing their first quarter of adjusted EBITDA profitability in 3 years, and then from macro factors like the increasing likelihood of a Federal Reserve rate cut in September. On the Wall Street side, the caution is still very much alive, with analysts trimming revenue forecasts, highlighting seasonal slowdowns in real estate, and warning about the lingering impact of high interest rates on home purchases. Let's unpack what's going on here. Starting with the retail perspective, Opendoor's latest earnings gave a lot of small investors exactly what they've been waiting for, proof that the company can be profitable, even in a tough market. They sold 4,299 homes in Q2, generated $1.6 billion in revenue, and brought in $23 million in adjusted EBITDA. Those numbers matter because they signal that Opendoor's operational model can work without the tailwinds of a red-hot housing market. For retail investors who've stuck with the company through the massive sell-off from its highs, we're talking a decline of over 90%. This was a morale boost. Add to that the macro backdrop, where weaker jobs data has led big names like JP Morgan to expect a rate cut as soon as September, and you've got a narrative retail traders love, a company turning the corner just as the broader economic conditions are about to shift in its favor. This optimism helped fuel Friday's bounce, with Opendoor closing up at $1.95 per share, a solid gain from the post-earnings lows earlier in the week. It wasn't just a random pop, it was a sign that dip buyers are stepping in when they see value, especially with the stock having been punished so heavily in recent days. But here's the flip side: Wall Street isn't ready to throw a parade just yet. Analysts have been quick to point out that Opendoor's guidance for the rest of the year is still muted. Management has warned about softer acquisition volume ahead, and a big reason is the seasonality of the real estate market. Q4 is typically a slower quarter for home transactions, and that's before you even factor in the still high mortgage rates that are keeping many potential buyers and sellers on the sidelines. From an institutional perspective, the path to sustained profitability still has hurdles. The housing market remains constrained, competition in the iBuying space is tough, and while a rate cut could help, it's far from guaranteed to create an immediate surge in transactions. This divide between retail and Wall Street has been on full display all week, not just in the numbers but in the conversation around the stock. On social media and retail investor forums, you're seeing posts celebrating the earnings, speculating about short squeezes, and sharing charts showing bullish technical setups. Meanwhile, research desks are emphasizing risk management, longer timelines, and the need for more consistent profitability before changing their ratings. The tension was also amplified by the shareholder open letter that surfaced this week, shared by investor Eric Jackson. The letter voiced frustration with current management, called for greater accountability, and even suggested the board consider leadership changes if the current team can't execute more decisively. Jackson himself has been vocal in media appearances, like his spots on Yahoo Finance and Bloomberg Radio, where he balanced his criticism of management with continued belief in the company's long-term potential. This is where things get interesting. Retail investors often rally around activist pressure, seeing it as a sign that insiders and large shareholders are pushing for the same changes they want. Wall Street, on the other hand, tends to be more cautious with activist narratives, waiting to see whether they actually lead to tangible operational improvements. So what does all of this mean for the stock as we head into next week? In the short term, volatility is almost a given. With earnings still fresh in people's minds, macro data coming in, and speculation about Fed policy running high, we could see sharp moves in either direction. If retail momentum continues to build, especially if there's any follow-through from Friday's rally, we might see a pushback toward the $2.10 or $2.20 range in the near term. But if Wall Street's caution dominates, we could see the stock consolidate or even retest some of the post-earnings lows. The medium term, though, is where this tug-of-war will really play out. If the Fed does cut rates in September, mortgage rates could ease enough to bring more buyers and sellers back into the market, which would directly benefit Opendoor's transaction volumes. That would strengthen the retail case and potentially start to bring some analysts around to a more bullish stance. But if rate cuts are delayed or the housing market remains sluggish despite them, the Wall Street skepticism could prove justified, and retail enthusiasm could cool off. For long-term investors, the key question is less about next week and more about whether Opendoor can sustain profitability while growing its market share. The Q2 numbers were a good first step, but one profitable quarter doesn't guarantee a trend, especially in a business model that's so sensitive to macro conditions. What we're really watching is execution. Can management navigate the seasonal slowdown while keeping margins healthy? Can they adjust acquisition strategies quickly enough to match market realities? And will they respond to shareholder concerns in a way that rebuilds confidence across the board, not just with retail traders? That's why this tug-of-war is so compelling right now. On one side, you have retail investors energized by a combination of better-than-expected earnings, activist voices calling for accountability, and a macro picture that could shift in their favor. On the other, you have analysts urging caution, pointing to the inherent volatility of the housing market, and reminding everyone that execution over multiple quarters is what will ultimately determine the stock's fate. Heading into next week, both sides will be watching the same catalysts: Fed commentary, housing market data, and any new signals from Opendoor's leadership. If those align with the retail narrative, we could see momentum build into a stronger recovery. If they align with the Wall Street narrative, this week's bounce could prove to be just a temporary reprieve. Either way, one thing's clear: Opendoor is at the center of a market story that's about more than just one company's earnings. It's about the clash between conviction and caution, between those who see opportunity now and those who want to wait for more proof. And that's what will make the next few weeks so fascinating to watch. So as we wrap up this week, I want to hear from you. Are you team retail optimism or team Wall Street skepticism? Are you buying this dip, holding your position, or waiting for more clarity before making a move? Let me know in the comments. And as always, if you found this breakdown useful, don't forget to like, subscribe, and hit the bell so you don't miss next week's updates. We'll be tracking Opendoor closely and bringing you the latest developments as they happen.